Welcome to NVSR channel. Today we are going to see about the Indian economy. From that Indian economy, chapter 2, national income. From this chapter we are going to see national income, methods and measure, estimate of national income in India. Now let us see that. First of all, what is mean by national income? National income of a country is a total income generated by the residents of a country in its economic territory in a particular period of time, usually 1 year. This definition of national income is very generic and not in strict sense of economy. The growth of national income helps us to know the progress of the country. This chapter covers the method of measuring the national income, measures of national income, and estimate of national income in India. First, we are going to see about the methods. National income methods and measure. There are various estimates of national income. Each estimate helps in measuring the national income in different perspectives. Before learning these methods, it is important to understand the flow of income among various players who take part and contribute to the national income. There are 4 layers, namely individuals or households, business firms or investors, government, and foreign nationals. For the sake of simplicity, we shall consider only first and second. Let's see. The flow diagram shows the flow of income household between the household and the business firm. The upper part shows the supply side of the economy, and the lower part shows the demand side of the economy. In the upper part of the household, supply factor of production is labor, land, capital, and entrepreneur to business firms to produce goods and service. In return, the business firm give wage, rent, interest, and profit to labor, land, capital, and the entrepreneur respectively. The wage, rent, interest, and profit were expenditure to business firms, but income to the households. So once income is other expenditure. Hence, it is evident that the expenditure of one player and the income of the another player are equal. So the national income can be calculated by comparing income of the all or expenditure of all. The calculation of national income by comparing income of the households is called income method. From the bottom of the figure shows that flow of goods and services that are produced by the business firm and demanded by the people. For the flow of goods and services produced and supplied by the business firm, households pay money. Hence, the value of goods and services produced, price into quantity, is equal to the expenditure incurred by the households. On the purchase of these goods and services, both are equal. So, the national income can be calculated by calculating total value of all goods and services or by compiling the total expenditure incurred by the people. The former is called product method or output method or production method or value added method. Later it is called the consumption method or expenditure method. From these method we have 3 types. Product method, methods of measuring national income. Number 1, product method or output method or production method or value added method. Number 2, income method. Number 3, expenditure or consumption method. The Ministry of Statistics and Program Implementation, Government of India, introduced a new service of national income estimation in January 2015, guided by the recommendation of the International Guidance on the Subject System of National Accounts SNA 2008. Let us call it shortly new series. As mentioned earlier, there are various measures of national income. Each of these measures the national income in different perspective. They are similar to one another. Measure of national income: GDP, NDP, GNI, NNI, GNDI, NNDI, GDIG, GDIH. Before knowing about the GDP and other measures of national income, it is essential to know about the other 2 measures. They are GVA at the basic price, GVA at the factor cost. GVA at basic prices. GVA stands for gross value added. GVA at basic price is also called GVA producer prices. The term basic price is the alternate term to describe producer price. It is different from the market price or buyer price. The producer price is equal to production cost. The buyer price over and above the producer price include product taxes less product subsidies. Buyer's price equal to producer price plus product tax minus product subsidies. The GVA is arrived from the output of the 11 industries. The 11 industries are listed as number 1 agriculture, forestry and fishing. Mining and number 2 mining and quarry. Number 3 manufacturing. Number 4 electricity, gas, water supply and other utility services. Number 5 construction. Number 6 trade, repair, hotel and restaurant. Number 7 transport, storage, communication and service related to broadcasting. Number 8 real estate, ownership of dwelling and professional services. Number 9 public administration and defense. Number 10 financial service. Number 11 other services. The output consists of input material and services, which is called intermediate consumption, and the value of addition made to input material and services to bring it to final goods and service. Output equal input materials and services plus value added. So to arrive gross value added, the intermediate consumption is deducted from the output value. It is in formulas as below. GVA at basic price, output minus intermediate consumption. Take an example of wheat flour. It is manufactured in manufacturing industry and its final product of manufacturing industries. Let us take value of 1 kilogram of wheat flour at the basic price of rupees 80. So the output is 80. To manufacture wheat flour, wheat and electricity are needed to be used in inputs. Wheat and electricity are outputs of the other industries. Wheat is output on our agriculture sector. Electricity is output of electricity, gas, water and other utility service sector. They are already accounted as the output of those sectors. Hence, they are deducted from the output of the manufacturing sector to arrive at the value addition of manufacturing sector. Let us assign value of the inputs. Input value of wheat 20. Input value of electricity 10. Let us calculate gross value added by wheat flour manufacturing industry. GVA at basic price equal to output minus intermediate consumption. Gross value added by wheat flour manufacturing industry equal to output of wheat manufacturing minus input of wheat flour manufacturing. That is 50 equal to 80 minus 30. The gross value added by wheat flour manufacturing industry is 50. The value of addition is done by the entrepreneur or enterprise engaging employee and plant and machinery. The entrepreneur or enterprise employee and the plant and machinery are called factor of production. The enterprise or entrepreneur employee need to be rewarded. In addition to this factor production, these services of government are being used for which an enterprise need to pay land revenue, license fees, etc. These payments up to government are to be made irrespective of the fact whether the production is done or not. These expenditures are called production taxes. At the same time, the enterprise receives production subsidy from the government. There is difference between tax on products and tax on production. Tax on product includes tax like a sales tax and excise duty. It is a tax imposed as it was produced and sold. Tax on production refer to a tax imposed irrespective of production like license fees and land tax. Production tax or subsidies are paid or received with relation to production and are independent of the value of actual production. Some examples are production taxes minus production tax, land revenues, stamps and registration fees and tax on profession. Production subsidies: subsidy to railways, input subsidies to farmers, subsidies to village and small industries, administrative subsidies to corporation or cooperatives. The plant and machinery fall under the category of the capital asset. It undergoes wear and tear in the manufacturing process. It is a sort of consumption. It is called a consumption of fixed capital. The reward to employee, entrepreneur, enterprise and a consumption of fixed capital is called factor cost. All these are expenditure to manufacturing wheat flour. All these added together is the value addition done to wheat and electricity. It is gross value added by wheat for manufacturing industry. Gross value added to basic price, consumption of employee plus operating surplus mixed income plus consumption of fixed capital plus production taxes less production subsidies. The payment made to employee are called consumption to employee, and the payment made to enterprise is called operating surplus or mixed income, OAS or MI. The machineries and the building used to undergo wear and tear. The wear and tear leads to loss in the value of the machinery and the building. It is called the consumption of fixed capital. The production tax are taken net of the production subsidy. Compensation of employee. Compensation of employee is defined as a total remuneration in cash or in kind of payable the enterprise to the employee in return for work done by the latter. In simple terms, it is wage and salary paid to workers and employees either in cash or in kind. An example of payment made in kind is agricultural produce given to the agricultural laborers. Operating surplus or mixed income. Operating surplus or mixed income is a measure of the surplus accruing from the process of production before deducting any explicit or implicit interest charges, rent, or other property income payable on the financial assets, land, or other natural resources required to carry on the production. The surplus is arrived by deducting compensation to employees and production tax less production subsidies and the consumption of fixed capitals from gross value added. The surplus so arrived in the case of the incorporated enterprise are called operating surplus. The surplus arrived in the case of unincorporated enterprise are called mixed income. Incorporated enterprise refer to the enterprise that establishes a separate legal entity. A separate legal entity is an entity which can be treated like a human being. It is capable of entering into contracts and on failure of this contract can be used. It can be used in a court. It can be borrowed from anybody and it has to repay. The example of incorporated enterprise are companies under limited liability partnership (LLP) registered under the Company Acts. If the legal entity is not able to repay the borrowed loan, the investors or promoters of the legal entity is not responsible to repay the loan availed by the company. For example, for the default Kingfisher Airlines etc., Vijay Mallya cannot be held responsible unless it is proved that Vijay Mallya misused his position and misappropriated the borrowed funds. Even the promoters or investment itself is a liability of the company. It owes to investor or promoter. The company is altogether a separate person from this investor and the promoter. The fixed asset and other asset created out of the investment are of the legal entity and not the investor or promoter. Unincorporated enterprises are enterprises that are not incorporated and separate legal entity. There is no distinction between the owner, investor, and the entity. Example of unincorporated entities are property concern partnership firms. The property concern cannot enter into any contract. They cannot borrow. Everything should be done in the name and by the owner or investor. The unincorporated services are owned by the households in which the owners or the members of the same households may contribute unpaid labor input of similar kind of to those that could be provided by paid employees. The household do not charge separately for the labor contributed by their own enterprise. They take the entire surplus. The surplus is described as a mixed income because it implicitly contains the elements of remuneration for the work done by the owner or other members of the household that cannot be separately identified from the return to the owner as an entrepreneur. In many cases, the element of remuneration may dominate the value of mixed income. In practice, all incorporated enterprises owned by the household that are not quasi-corporation are deemed to be a mixed income, except owner occupies in their capacity as a producer of housing services for own final consumption, households leasing dwelling and households employing paid domestic staff. Per owner occupies those leasing dwelling, all value added is operating surplus. For domestic staff, all value added is compensation of employee unless any tax or subsidies on production are payable or receivable on the output. Consumption of fixed capital. It is a decline in the current value of the stock of fixed asset owned by and used by the producer as a result of physical deterioration. normal mobilization of normal accidental damage. The term depreciation is often used in place of construction of fixed capital, but it is avoided in the SNA because in commercial accounting the term depreciation is often used in the context of writing of history cost, whereas in SNA the consumption of the fixed cost is dependent on the current value of the asset. Writing of the historic cost denote that irrespective of the amount of physical deterioration, normal obsolescence or normal accidental damage, reduction is writing up the historic cost of denotes that irrespective of the amount of physical deterioration, normal obsolescence or normal accidental damage, reduction is made on certain percentage of the value of the fixed asset from the original purchase cost. For example, if a machine was purchased in 1 lakh, writing of historic would refer to reducing 10,000 from the value of the machinery every year to arrive the year-end value of the machinery. In SNA, consumption of fixed capital is arrived after detecting the current value of the asset from the initial value of asset. The current value is estimated using various techniques available. Consumption of fixed capital calculated through the initial value of asset can be subtracted from the current value of asset. Initial value of asset is actual value of the asset at the beginning of the year and the current value of asset is actual value of the asset at the end of the year. Production taxes. The production taxes are taken as the net production subsidies, that is production taxes minus production subsidies as an expenditure on account of production taxes come down to the extent of production subsidies. It is taken production taxes less than production subsidies. To put in the formula, the gross value added then is follows. Let us assign the value to factory used for value addition to wheat and electricity to produce wheat flour. From the last example, compensation of an employee is 15 rupees. Operating surplus or mixed income is 20 rupees. Consumption of fixed capital is 10 rupees. Production cost taxes 10 rupees. Production subsidies is 5 rupees. Gross value addition 15 plus 20 plus 15 plus 10 minus 5 equal 50 rupees. GV at factor cost. The value of gross value addition made excluding the production tax less production subsidy is called GV at factor cost. GV at factor cost. Output minus intermediate consumption minus the production taxes minus production subsidies. GV at factor cost is equal GV at basic price minus production taxes minus production subsidies. GV at factor cost is consumption of employee plus operating surplus or mixed income plus consumption of fixed capital. Here the value addition is comprised only by only a revert to factor of production, which is called factor cost. From above discussion, it is clear that gross value added is strictly production measure defined only in terms of output and intermediate consumption. With a clear understanding of the concept of GV at factor cost, GV at the basic price, we can move to the concept of GDP and other measure of national income. Production method. Gross domestic product GDP. Gross domestic product at market price is equal to sum of the gross value added at the residential unit plus those tax less subsidies on product. It denotes gross value added plus tax and product less subsidies on products. GDP at market price is called as shortly GDP. Product taxes are paid and product subsidies are received per unit of product. Some examples are product taxes, excise duty, sales tax, service tax, import and export duties. Product subsidies, food, petroleum and fertilizer subsidies, interest subsidies given to farmers, households, etc. through banks. Subsidies for providing insurance to households at lower rates. It is necessary to have a clear idea about resident units. The concept of resident unit in the SNA is not based on the nationality or legal criteria. If an institutional unit has a center of predominant economic interest in the economic territory of the country, it is said to be a resident unit of the country. That is, when it engages for an extended period of 1 year or more in economic activities on its territory. Institutional units are economic units that can engage in the full range of transactions and are capable of owning assets and incurring liability on their own behalf. Examples for institutional units are manufacturing units, banks. It is necessary to have a clear idea about the economic territory. The most commonly used concept of economic territory is the area under the effective economic control of single government. An economic territory includes the land area including island, airspace, territorial water, and territorial enclave in the rest of the world, such as embassies, consuls, military base, science station, information or immigration office that have immunity from the law of host territory. Physically located in other territory. Economic territory has the dimension of physical location as well as the legal jurisdiction, so that corporations created under the law of the jurisdiction as part of the economy. The economic territory also includes special zones such as free trade zone and offshore financial center. These are under the control of government and so are part of the economy. Even though different regulatory and tax regime may apply depending on the country where it is located, the territory excludes international organizations and enclave of other government that are physically located in the territory. GDP is a production measure as is obtained by summing the gross value added of all resident institutional units in their capacities as a producer and adding the value of any taxes less subsidy on the production or import to the gross value added. Next we are going to see NDP, net domestic product. Net domestic product is arrived after deducting consumption of fixed capital from gross domestic product. NDP equal to GDP minus consumption of fixed capital. In principle, the concept of value added short did not include in the consumption of fixed capital. Consumption of fixed capital is not a current expenditure. It is a reduction in the value of previously created fixed asset when they are used in the production process. It is just a reduction in the value of the fixed asset. Wear and tear is like a evaporation of the petrol and diesel. It means it's spent but did not benefit anybody. It is a part of the expenditure in the production process, but not in the income of anybody who is involved in the production process. Thus, theoretically, value added shouldn't be net concept, and GDP should be a net concept. Hence, consumption of fixed capital is deducted from the GDP, and thereby NDP is arrived at. However, gross measure of product and income are commonly used for various reasons. It is due to difficulty in measuring and obtaining data of consumption of fixed capital and to enable international comparison. The calculation of consumption of fixed capital requires that statisticians estimate the present value of stock or fixed asset, the lifetime of various types of asset, pattern or depreciation, etc. Estimation require well qualified statistician data and tools which is generally not available in all the country. Hence, not all the country make such calculation. The estimation of the countries doing estimation is not comfortable due to the difference in the methodology followed in the estimation with inadequate data. The gross measure is devoid for these difficulties to some extent and comparable to as all countries measure value addition on gross basic, and they are generally considered more comparable between countries. So GDP is broadly used even if it is economically inferior to NDP. On the conceptual basics, however, NDP should also be calculated with improved estimates of consumption of fixed capital when necessary in order to provide significant tool for various types of analysis. Next, we are going to see the income method. Gross national income (GNI). Gross national income is the aggregate value of gross balance of primary income of all residence institutional units It is an income measure. Primary income or income that acquired to institutional units are consequence of their involvement in process of production or ownership of assets that may be needed for purpose of production. A major item of primary income is compensation of employees that represent the income accruing to individuals in return for their labor input into production process. Primary income that acquired by lending or renting financial or natural resources, including land, to other units for the use in production is called property income. As these two components are earned by factors of production, namely labor and entrepreneur, they also called factor income. Receipts from the taxes on production and imports, less subsidy on production and imports, are treated as a primary income of government. Primary income do not include the payment of social contribution to social insurance schemes and the receipt of benefits from them, the current tax on income, wealth, etc. The other current transfer, in short, it does not include the current transfer. Current transfer I explained later. As explained earlier, the value added is equal to the income equal to the institutional units involved in the production process, that is value addition process. Hence, GDP should be equal to GNI, but all the income does not acquire to the residential institutional units. Primary income generated in the production activity of the residential producer unit within the economic territory are distributed mostly to other residential institutional units. However, part of them may go to non-residential units. In the same way, part of the primary incomes generated in the production activity in the rest of the world by the resident units are distributed to the non-resident units. Some of the non-resident units may be resident units, and some income is distributed to our residence units. Hence, GNI can be arrived by adding net primary income of GDP. The difference between primary income acquired to non-resident institutional units in the economic territory of the country and income acquired to resident institutional units in the rest of the world is called net primary income from the rest of the world. As per the SNA 2008, GNI is equal to GDP less primary income payable to non-residential unit plus primary income receivable from the non-resident unit. In other words, GNI is equal to GDP less tax net of subsidies on the production and import of compensation of employee and property income payable to the rest of the world plus the corresponding items receivable from the rest of the world. Thus, GNI is sum of gross primary income receivable by resident institutional unit or sector from the domestic economic territory and foreign economic territory. GNI is expressed in formulaic form follows. GNI, the shortened version of the above formula is GNI equal to GDP plus net primary income from rest of the world. The word net indicates receipt of resident institutional unit less payment to non-resident institutional unit. The word rest of world indicates area lying outside the economic territory. The process note a new series estimate on the national income, consumption, expenditure, saving and capital formation released by the Ministry of Statistics and Program Implementation, Government of India, dated 30th January 2015 as the formula of various of national income. As per this note, the formula for GNI is GNI equal to GDP plus net primary income from rest of the world. It has been formula for net primary income from the rest of the world also. As per this note, the net primary income from the rest of the world has two components. They are net compensation of employee, net property of entrepreneurship income. The formula form is written as follows. Net primary income from rest of the world is net compensation of employee plus net property and entrepreneurship income. Hence, GNI equal to GDP plus net compensation of employee from the rest of the world plus net property and entrepreneurship income from the rest of the world. The net primary income of the government is not accounted as per the above formula. The process did not elaborate the reason for the same. If net primary income from the rest of the world is positive, GNI is higher than GDP, vice versa. GNI is higher than GDP if net primary income from rest of the world is positive. If GNI is lesser than GDP, if the rest net primary income from rest of the world is negative. Difference between GDP and GNI. Both GDP and GNI are obtained by the summing over the same set of resident institutional units. There is no justification for labeling one as a domestic and the other as a national. Both aggregate refer to the total economy defined as the complete set of resident institution units or sectors. The difference between them is not one of the coverage, but the fact that GDP measures production while GNP measures income. Both have an equal claim to be described as a domestic as a national. However, as the term gross domestic period and gross national income are deeply embedded in the economic usage, the Senate did not propose to change them. Emphasis should be given, however, to the third rather than second related of the economy. The emphasis on fact GDP refer to the production, output GNP to income. The catchword for GDP is product. The catchword for GNI is income. GDP is strictly production measure. GNI is strictly an income measure. Net national income (NNI). The net national income is arrived after deducting consumption of fixed capital from gross national income. NNI equal to GNI minus consumption of fixed capital. It is known as the national income. By dividing this by estimated population per capita income is arrived. Gross national disposable income (GNDI). Disposable income refer to income that is available which can be disposed, spent or saved. Disposable income available for spending plus income available for saving. All the income received cannot be spent. Direct tax payments like income tax are to be paid out of the income. These have to be deducted to arrive the disposable income. Gross national disposable income measures the income available to the total economy for final consumption and gross saving. National disposable income is the sum of disposable income of all resident institutional units or sectors. The whole primary income received by the factor of production involved in the production process is not retained by them. A part is transferred to non-resident. At the same time, resident units may receive transfer originating out of primary income to the rest of the world. Gross national disposable income is equal to GNI less current transfer other than tax less subsidy on production and imports payable to non-resident units plus the corresponding current transfer receivable by resident unit from the rest of the world. GNDI equal to GNI current transfer available receivable by receiving resident units from the rest of the world minus current transfer payable to non-resident unit to the rest of the world. GNDI equal to GNI plus net current transfer from rest of the world. As said earlier, GNI does not include current transfer. By adding it to GNI, the GNDI is arrived. Current transfer is a transaction in which one institutional unit provides a good or service to another unit. It is provided without receiving from the latter any goods or service directly and return as a counterpart. It does not oblige one or both parties to acquire or dispose of an asset. Current transfer payments are made as a part of the social responsibility. The receiver need not to pay anything in return directly. These payments are made not against any productive activities on the part of the receiver. The example are old age pension, unemployment compensation, disaster relief payment, interest paid on public debt, tax paid to government, etc. Tax paid to government is an example of current transfer. Tax is a compulsory levy payable by an institutional unit to the government without any corresponding entitlement to receive an definite and direct quid pro quo from the government. Quid pro quo refers to something given or taken equivalent to another. Three main kind of current transfers are current tax on income, wealth, etc., social contribution and benefits, other current transfer, current taxes on income and wealth, etc. It consists of mainly on taxes on the income of households or profits of corporations and of taxes on wealth that are payable to government. To put in the short, it consists of income tax, wealth tax payable by the households and the corporation to the government. B. Social contribution and benefits. Social contributions are payments to social insurance schemes and other social security payments like a provident fund, payment to new pension scheme, etc. These payments are made either by employee or employees or by both. Households themselves make these kind of payments in their capacity as employed, self-employed or unemployed persons. Social benefits. A current transfer received by households. It is intended to provide for the needs that arise from the certain events or circumstances, or example, sickness, unemployment, retirement, housing, education, or family circumstance. Social benefits may be provided under social insurance scheme or by social assistance. Example for social insurance schemes are Pradhan Mantri Suraksha Bima Yojana, Pradhan Mantri Jeev Jyoti Bima Yojana. An example of social assistance is Indira Gandhi National Old Age Pension Yojana. Other current transfers. This is part 1 of national income in Indian economy. We are going to part 2 of this videos. Thank you for watching. Please like and share NVSR channel. Subscribe NVSR channel. Thank you. All the best.